Scarred by the global financial crisis, investors have since fled to high-quality companies that they hope and trust offer the safety of sustainable earnings growth. In true value manager style, RCM sees this as an opportunity. Senior analyst Paul Whitburn joins us in studio to discuss these opportunities. Welcome, Paul.
Thank you.
And we just have to say, so quite the antithesis to the conversation we've just had about thematic investing, which to my mind looks a bit like growth-themed investing. For you, it's the opposite, looking bottom up.
Absolutely. So, here speaking a lot about the pharmaceutical industry and the like. We looked at the pharmaceutical industry 3 years ago when those stocks were trading at 7-8 multiples and about the same dividend yields. And we also felt that, those stocks had gone ex-growth, they had their drugs coming off patent, and many of the investors just threw them away, saying they're ex-growth, we don't want to own them. So we bought a basket of those stocks, trapping 90% of the world R&D spend in pharmaceuticals. And today our clients in the global fund still own a good piece of that pharmaceutical pie, but we bought it back in the day when it was unloved. Nobody wanted to touch pharmaceuticals. Everyone wanted to be in resources. That was the theme of the day, the commodity super cycle. So yes, we catch these things early, but not because it's a theme, because the value's there, because we analyze the assets and we believe in what the intrinsic value is.
Paul, you made a presentation to clients today, and one of the slides that struck me was the divergence of different indices on our local market.
Yep.
The market's been going up every day, almost oblivious of what's been happening in the local economy. But just take us through what the opportunity is for you and just how widely those indices have diverged.
So we looked at that indice back to sort of 2000, price to book values, because we don't want to use earnings because cyclical companies such as steel companies and miners don't make any earnings at this point. But we looked at the price to book values of those indices going back against themselves. And what we're seeing is that the industrials are getting very, very expensive, sort of 40-50% overpriced. You can think of them, British American Tobacco, Richemont and the like, breweries. And then on the other side of the scale, we have the resource sector, which at the moment is 30-40% below its long-term price to book value. And then the financials are somewhere in between. So yes, the market's hitting all-time highs, but it's the industrials that are dragging them higher. The resource stocks, and platinum's even worse. If you looked at the divergence even greater, platinum stocks versus resource stocks. So today you buy Impala Platinum at 1 times book, long-term book price to book is sort of 2.5 times. So clearly this is a part of the market that people don't want to own because they want to own the franchises. Everyone talks about quality these days. They want to own. I remember the Nifty 50 was exactly what we're entering now, where people think these quality stocks are bonds, but we think it's incorrect.
Just I think for the benefit of viewers, Nifty 50 was a term the Americans referred to 50 companies in the 70s, if I'm not mistaken, that were very similar to what the top performing stocks on our local market are.
Absolutely, and they re-rated considerably. They went from 20 times multiples to 40 times multiples. So this can last a lot longer than what you anticipate. But we think, the conservative thing to do is to go where the value is. And right now, it's cyclicals, it's resources locally, and that's where we're putting our clients' capital.
But that undervaluation can also last a long time. So mining stocks have been undervalued for some time, and value investors have been saying for 2 years or so, buy whatever, whatever it might be, and they've been burning since then.
Yeah, so that's exactly it. It's been about 2 years since we've been slowly rotating our client funds into the resource sector, and our sort of time frame is 5 years. Because generally, it takes 5 years for a business cycle to work out. And remember, if you think about a platinum mine, how long does a cycle take? How long does it take to sink a platinum shaft, get the ounces out of the ground? It probably takes longer than 5 years. So this is the big thing, is that the cycles are possibly a lot longer. You need the dynamics and the demand and supply dynamics to change in the market, which is happening in platinum. And then eventually earnings will start to come through because you've had higher prices, weaker rand, and guys will start coming for the stocks when they see earnings again. But sometimes it's too late.
You've got this situation with especially the platinum companies where you've got a very interesting labor dynamic, and I understand the value approach and how companies move through cycles, and a market like the platinum market moves through cycles. But so far as I can see, this is one of the worst labor situations we've had in mining companies, and we're talking even back to the apartheid era with labor then. Has the story got worse for you? I mean, in a situation like this where there still seems to be so much downside risk, do you take a position of expecting it to go down further and acquiring, or do you kind of got a value that you're prepared to buy a stock at and leave it there and sit with it?
Yeah, so I mean, it all depends on the discount to intrinsic value. So at a smaller discount, we have a small position in the underlying company. We also have a quality overlay where if it's a very liquid, high quality business such as Anglo-Plats, we'd have a slightly larger position than maybe a smaller, more marginal platinum producer such as Lonmin. So we scale the positions differently, and as that discount opens up over time, so we add to the position. So that as it carries on falling, we're able to add to the position all the time, buying at cheaper prices. As far with regards to the labor situation, with platinum it's a little bit different. Everyone's got the same labor issues. Everyone's got the same cost issues. Those cost issues have to eventually feed through to a higher basket price of platinum commodities, PGMs. Very different for gold, because now you've got to compete against other gold miners around the world, and now you're becoming less competitive because of cost increases due to labor and the like. So it's a little bit different for different commodities. It's where you have your oligopoly, which is platinum. So that's why we really focused on that part of the market. And we think the underlying commodity is cheap. So that's also a different point of departure. We don't like iron ore, for instance. So we're really picking our battles here.
Paul, if you go to the top 10 holdings in your flexible equity fund, so they are the stocks you refer to, the Amplats, Lonmin, Implats, there's also Anglo American and ArcelorMittal. But top of the pops there is Sun International. What's the story?
So our clients have held Sun International for some time in various different sizes, obviously, depending on where it's traded compared to its intrinsic value. Once it is a high quality business in our opinion, purely because of the casino licenses, limited number of casino licenses, and they've generated good returns over the last sort of 10, 15 years. But it's also got a cyclical part of the business, which is the hotels and leisure side. Massive overbuilding that happened post Soccer World Cup. We saw vacancies fall to 50%, and then slowly capital was withdrawn out of the hotel sector, and hotel rooms have now filled up. Guys are upping their rack rates, and what we're seeing now is that the hotel sector is actually generating good money. So it's quite a stable business in the casino side with a very cyclical play on the hotel side, which is turning up, and we're starting to see in HCI, which is one of our holdings, Tsogo Sun and Sun International, we're starting to see those earnings come through, because there was a massive divergence, remember, between retail earnings and casino gaming earnings. And we just think there's a barrier to entry in gaming while not in clothing retail, simply put.
I think we've got one more time
yeah.
for a question. Paul, I can't resist to ask you, all the news this week has been about African Bank. What's ReCM's take on this forlorn unsecured credit lender?
Yeah, I mean, it's trading close to book. And once again, if you look at the long-term multiples, it's one of the cheapest entry points you've had within Able. I mean, we owned Capitec back in the day, but we were paying half book for it. At 5 times book, it's not part of our client portfolios. So we are looking very closely at it. We've got our numbers down, and it is a sector of the market right now that interests us. We own JD Group in that space and have for some time. So yeah, the unsecured lending, specifically Able is looking very interesting at this point.